This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started.
So with me, every client's they have their own issues, right? Some clients have some tax strategies will work for some clients, and some tax strategies won't. So for me, it's all about getting to know my clients. Really want to get to know, what's important to them. Get to know their families, their goals, their businesses, and then we can kind of take a full 360 approach to the tax strategy.
So, Greg, it sounds like your approach to servicing your clients is more of a year-round responsibility, not just, year-end tax preparation and filing.
Yeah, we take more of like a 15-month approach, right? So we start in January, and we'll start and we go right up until we file the tax returns in March or April of the following year. If you come to me in March and April of the following year and ask me to save money on taxes, there's not much I can do. At that point, I'm really just more of a historian. But if you start working with me on January 1st, and then we have a good solid 12 months to tax plan and make sure we're paying estimated taxes and make sure we're taking advantage of all those opportunities, then that's where I can really be a true asset to my clients. Yeah. So if you think about building a house, right, you have your foundation. For me, that's like the books and records. I always tell my clients, I can only do so much if your books and records are not in good shape. I always advise, getting a really good accountant. Of course, using SmartBooks accounting is a great option. And so once you have that foundation, you have that solid set of books and records that I can really trust. Then we get into the framing of the house, right? So then we get into, entity structure. Are you set up correctly? Are you an LLC? Are you taxed as an S Corp? Should you be a C Corp? Should you have multiple entities maybe? And then we get into kind of the essential items, right? So electric, plumbing, stuff like that. And for me, that's kind of the basic book to tax differences. So a lot of people probably don't realize that their financial statements are prepared on one set of rules, whereby I follow a completely different set of rules. Generally, you're going to have you have to develop what they call nexus in a state to have a tax requirement. So the first question I get is, well, what is nexus? Nexus is your business's connection with a state or local taxing authority. It's created really one of three ways. It's created it's based on where your customers are. So like where you're selling to. It's based on where you own or lease property. So if you hold inventory, that's a good example of people who sometimes get caught. They might say, "Oh, I don't have any connection to Connecticut," but then you find out that they have inventory sitting in that state, waiting to be delivered to the New England area, and unfortunately, that does bring them into that does create nexus. Yeah, sales tax. So a few years ago, when the Wayfair decision passed, basically, to give you a quick recap on that, your grandfather's company in 1985 that would ship, or maybe that's a little early, but whatever. The companies before the Wayfair decision that would potentially just ship goods to another state, customer in another state. Once it touched the UPS truck, it was no longer their issue. The states had no idea, how to manage this process, and the Wayfarer decision changed that and basically said that if you have sales to a specific state, then you are potentially subject to sales tax, and uh, that created a massive filing requirement for businesses across the board. So beneficial ownership is defined in this case as anyone who controls at least 25% of a company or has substantial control over a company. And so, you can kind of go down the line of, if you are an individual owner of a business that owns another business, you may indirectly be a beneficial owner of a specific company. So any change to that basic information. So if you get married and your last name changes, that would be something. If you move, that would be something that you need to report. If you get a new license and the license number changes, and I'm not sure if that is something that ever happens. But anything from the original information that changes would need to be reported within 30 days of it changing. So I think the biggest thing is going to be when you have a partnership or an S corp or even a C corp that changes ownership. If you bring on a new partner, then now you have to go in and make sure that you report that.
Not really. I think 2024 is going to be pretty quiet because, I mean, if you think about when Trump's going to get into office and when the Republicans take over Congress, it's going to be the year's already going to be closed. So some things that we might see, and this is just me speculating, and I haven't seen this anywhere, is potentially the bonus depreciation reverting back to 100%, and then that state and local tax cap that I referred to earlier, the 10,000 cap. I wouldn't be surprised to see that get raised, but that might be more of a 2025 thing. Like I said, we'll see what January has to offer. I don't know if we'll see a lot of changes in 2024, like retroactive changes. Not to say that it hasn't been done. I believe a few years ago they even changed things into like February, which creates a lot of turmoil, not just for us as practitioners, but now the IRS has to update their system. Tax software companies have to update their system. People who are eager to file maybe don't get to take advantage of that right away. They have to file amended returns, which becomes another issue. And then you have your proactive tax preparers who will talk to you at year end, maybe do some tax projecting, maybe throw out a few pointers, and where the certified tax coach designation really comes into play is where the people who can work with you to really reduce your taxable income or your tax year over year. So if you're working with a certified tax coach like myself, you can we can try to save you $25,000-$30,000 a year. In 4 years, you're probably looking at maybe having an extra $100,000 in your bank account. Or you can also look at it as when you make that next quarterly payment, maybe you're reducing it by half or 75%. And I think some people get the tax planning versus tax projecting. I think they kind of gray that line a little bit. And there's a pretty significant difference between the two. If you have a CPA who's just
telling you what you're going to owe. Maybe they tell you in December what you're going to owe in April. Great. You can plan for that. I've done that for clients. But that's just tax projecting. They're not really providing a ton of value to you if they're not helping you reduce that tax liability.
Yeah, so I think it's here to stay now. February 18th, the federal court lifted the injunction. So now they're saying that you do have to file. It is mandatory. And so it's mandatory for businesses that were formed prior to January 1st, 2024. So last January 1st. If you started a business in 2024, you probably already filed because you had your 60-day mandatory filing period. They were nice enough to give us a few extra days to file. So your filing deadline is now March 21st. And it's same issues or same deals before, where it's some pretty basic information. It's more of a nuisance than anything else. But, again, most businesses are going to have to do this. There's not too many exceptions to the rule. Yeah, just recently we elected a pass-through entity election for a client, and we ended up saving them $29,000 in tax just by changing where you or how you pay the state tax. And the client didn't really have to do anything. It was just an election that we made on the tax return. And, he reached out to me and said, hey, why do I owe this money? And I said, well, if you pay it at this level, if you have your business pay it, you're going to save $29,000 in taxes. So he was like, cool, I'm going to do that. So I thought it'd be good to come on here and just have a quick discussion on what, as a business owner, like what you should be doing throughout the year after tax season. Because let's be honest, no one wants to think about taxes at all. And most people only think about it maybe like once, twice a year. But unfortunately, that could get you into a little bit of trouble. So my first point is to know that tax planning, it's a year-round sport, and it's something that you should be having conversations with, especially if you're a profitable company. You should be having conversations with your tax accountant throughout the year, whether that's to just check in, see if there's anything new on their end, or talk to them about things that might be happening through the business, because there might be things that are happening that have a tax impact that you don't realize have a tax impact, right? It's one of those, you don't know what you don't know, right? And we can be a little bit more proactive when we have that information.
So when should people be talking to their CPA?
I would say a mid-year check-in at the very least. June is, in my opinion, probably the best schedule. And every CPA is a little different on how they bill. But I know for me, if I had a client reach out and just send me a quick email or want to have a quick 5-10 minute conversation, I'm probably not going to bill for that. It may be something comes out of it where I do have to bill for, but I'd love it if more of my clients just gave me a quick chat. Absolutely. The next one, I tell this to clients all the time, maximizing deductions. So home office deduction, business mileage, anything where like the business has to reimburse you for expenses. A lot of business owners will just wait until the end of the year to do that. Some even wait until after year end, where that might actually be too late. I would love to see business owners reimburse themselves on a monthly basis. I know that that can be a little much. Everyone's busy and they might not want to go through that paperwork, but doing it more often catches more deduction. And so home office deduction, I have a spreadsheet I send to my clients. It's just a template that they can plug in their mortgage interest, real estate taxes, homeowners insurance, stuff like that. And they just reimburse themselves on a monthly, quarterly basis, if maybe that works better for some people. But I definitely wouldn't wait until the end of the year to count up all your miles, go through your calendar, because you're definitely going to miss stuff. The more likely you are to catch all the deductions. So, it's the end of tax season, and I kind of take this time to reflect back on things that happened, patterns I saw. And one of the things that popped up this year was W-2 withholding. Not something that maybe directly impacts all business owners, but, if you're an S Corp or a C Corp, it could definitely impact you. If you have business income or passive income that you're obviously not withholding on, then that could impact your tax situation and may warrant some extra withholding from your wages. Maybe your spouse needs to update their withholdings. I would say it's more of a maintenance item
and not super fun to talk about. We're not talking about tax savings and stuff like that, but it's like getting the oil changed in your car. You can call me or you call your CPA and we can certainly walk you through it. The IRS actually has a pretty cool interactive tool that you can use to calculate that withholding. And it's definitely something you want to do. Like I said, it's like an oil change. You want to do it maybe annually in January. Just something to temperature check and make sure that you're still withholding enough. If you get married, have a kid, maybe you start a new business, the way that you earn income changes. Like I said, if you start a business and your salary income goes down, but your business income goes up, so maybe you're like, oh, I earned $100,000 last year, but I'm earning $100,000 this year. Everything should be the same. Not necessarily, because the way that you're earning that income and how taxes are being withheld on that income are different. And that's what happened with one of my clients. The wife, her business started earning some income. His W-2 salary stayed the same. Their withholding stayed the same, but her income was not being withheld on. So they got kind of killed at the end there.
Absolutely, yeah. So, I mean, none of this is law yet. It could all change. It could all get scrapped. But things to like keep an eye out for if this does go through as it's written right now. I think there's a lot of benefits for business owners. Not sure how everyone feels about the other parts of it, but from a business owner standpoint, I think could be beneficial. So the first one, which I'm a big proponent of being in a high tax state, is the increased SALT deduction. I think as it's written now, it's going from $10,000 to $40,000.
So what does SALT stand for or mean?
State and local tax. So you probably, if you're a business owner or really any individual, you probably haven't itemized your deductions recently. Maybe you've been keeping track of all your medical expenses and you give them to your CPA every year and they don't do anything with them because you don't itemize anymore. This could change all that. And so when you itemize your deductions, you are allowed only $10,000 of your state and local taxes. And so that includes your real estate taxes, excise tax on your vehicles, and state income taxes. They want to increase that from $10,000 to $40,000. So you can see people who live in a high tax state, this could be very beneficial. You heard me talk a lot about the pass-through entity tax in other episodes. That was a provision provided by the states to kind of alter this or to circumvent this rule. You have a bonus depreciation going back up to 100%. This is important for businesses that typically operate at a loss, like if you're pre-revenue and this 179 does not apply to you, then historically in the last couple of years, bonus depreciation has been getting phased out.
So remind us, what exactly does bonus depreciation mean?
So bonus depreciation is the ability to depreciate your assets in the year that they're placed into service. The benefit here, or the idea here, is that the U.S. wants to promote businesses buying assets and, increasing infrastructure and stuff like that, spending money to stimulate the economy. It typically works. Obviously, it comes at a cost. And so it's been getting phased down. They want to increase that back up to 100%.
You got it. Yeah, so meals is probably the most popular one here, because not every business owner is going to travel for work, but I think more often than not, you're going to have some form of like meals that's related to the business. So generally speaking, meals are 50% deductible. Now, there's 3 criteria that make it deductible. It's a legitimate business discussion during the meeting, right? It's not lavish or extravagant, and you or your employee is present in the meeting. So this can apply to client lunches and dinners, meals while traveling or during trainings. So for example, last year I was in San Diego, or in January I was in San Diego. All my meals were 50% deductible because that was for a certified tax coach training. Unfortunately, back in 2018, and for those of us who play golf, this was a big hit because, you used to say, oh, well, it's a client meeting on the golf course, and you get to deduct your 18-hole round of golf. But in 2018,
They did away with that, and now entertainment is not deductible at all. Sporting events tickets, golf, trying to think what the other big entertainment pieces might be. But yeah, none of that is deductible anymore.
Yeah, so there's two kind of credits here. So you have the child tax credit, and then you have the child and dependent care credits, right? And your the child tax credit is up to $2,000 per qualifying child. So typically, your child under the age of 17, to help reduce your tax bill. And then you have the child and dependent care credit, and this is for what I think most people think about. Like kindergarten or not kindergarten,
Preschool?
like preschool, daycare, stuff like that. And what people don't realize is that there's opportunities in that child independent care credit that you don't always think of. So hopefully bring that to light. And with the passage of the Big Beautiful Bill Act, those have been adjusted slightly for taxpayers. So there is some change there this year for as long as you're putting them in that program so that you can go work. So if obviously if you're putting them in a program at I even if maybe you're working at night and you got to put them in like nighttime basketball league or something, as long as it's for you and your spouse to go work. I think the nighttime situation might be a little bit harder to justify if one spouse is home, but during the day you get summer camps. I know that for us, my daughter does chair, and so that costs us, it's not a huge expense, but like $300 a year. She's at after school, every day for that. So that is an expense that we can take. Now, a lot of people will try to sneak by like private school. So like if you pay for kindergarten, I know I mentioned kindergarten earlier, but kindergarten is where it stops. So you can have like preschool, daycare, before and after school programs. I know a lot of schools will offer. Yes. So hopefully, with the home office deduction, there is no mailing in checks. Maybe you'll have to make sure you get that direct deposit updated so that they can get that refund. But yeah, so like I said, client said, nope, can't take the home office because I have an office. That it's incorrect. If you have a place of business, you can still take the home office deduction. So what?
And Greg, just to clarify one thing, because people my age or older, we still remember there being like this official home office deduction with the IRS like 20 plus years ago. But I think what you're talking about is not like a particular IRS program or election. It's just general business operating expenses that happen to go toward a home office, right?
Correct. Yeah. So I think what you're referring to is the unreimbursed employee business expenses. That was an old rule prior to the Trump tax cuts. It was an itemized deduction. It was exactly what it sounds like, unreimbursed employee business expenses. People probably took advantage of it, but now this is really just for business owners. So now we get into the real estate. So what can we take? We can take mortgage interest, rent, real estate taxes, utilities, homeowners insurance. If you have an alarm on your house, home office repairs, stuff like, that you're doing to the entire house, or expenses for the entire house. You're going to take a portion of those expenses, right? And the idea is that you're going to take the square footage of your home office divided by the square footage of living space in your home,
and that's going to be the ratio that you use. So, you have a 1,000 square foot home and you have a 100 square foot home office. 10% of all those expenses that I just mentioned are now a home office deduction.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.